Hello everyone, this is Professor Capko, and I welcome you to the next video in our series on accounting. In this series, we're going over some of the basic concepts for accounting. If you're taking an accounting class or if you are starting your own business, these are some important concepts to know. Today, we're going to talk about the formation and the initial accounting for the assets that are put into a company to start it. In this case, we have Kathy Caterer is starting her catering business by investing $15,000 cash from her savings. And we also want to know that she plans to use a corporate entity as her form of business. So she's going to form a corporation. So we're going to use that as our basis, but the accounting would be similar if it's going to be a partnership, an LLC, some other entity like that. But we're going to, in this case, use a corporate entity. And the first thing to note is there's $15,000 cash coming from her, Kathy being the initial investor, the owner. So I'm going to show you using some T accounts, one of my favorite ways to demonstrate and keep track of what's going where. And it'll make it much easier to do the journal entries. So we have assets such as cash. Cash is an asset. In fact, it's my favorite asset. And since it's an asset, as you've seen in some prior videos, we know that we increase assets with debits and we decrease assets with credits. So anytime an asset goes up, we're going to be debiting it, and when an asset goes down, we're going to credit it. So in this case, we're counting from the point of view of the company, of the catering business, not from Kathy. So the company is receiving $15,000 cash. So its assets are increasing by $15,000. So I'm going to debit the asset cash for $15,000. Now, as you know, with double entry accounting, for every debit, there must be credits that equal that amount of the debit. So it doesn't matter the number of debits or the amount of credits, the total amount of money needs to equal on the debit side and the credit side. That is what we talk about balancing. So it must balance. So the balance to this is, since it's a corporate entity, we have an owner's equity. This shows the ownership interest, in this case, that Kathy the caterer has in her own company, but you could have multiple owners. But in this case, we just have one. And because we mentioned it's a corporate entity, we're going to show this in the form of common stock. I'll do some more videos regarding the different types of entities and how stock is treated. But we'll start out just simply saying we're using common stock. Because it's owner's equity in the balance sheet, that is going to increase with credits and decrease with debits. So in this case, we're increasing the owner's equity, and we're increasing it by an amount of $15,000. That's going to be our balancing entry. So we're going to credit owner's equity for $15,000. So now we have a debit of $15,000 for cash and a credit for owner's equity for $15,000 cash. So we know that it balances. Let's now show that as a journal entry. And this is why the T accounts make it that much easier. So if I've got on the left side here debits and the right side credits, and remember, debits pretty much just means left, credits just means right. We always start with the debits for our journal entry. So this is a journal. This is the general journal. And we're going to start with debits. And we look here, we debited, our debit is to cash. So I'm going to show that here as cash. And debits, because they're on the left side, we always push that entry to the left. So we write cash all the way to the left side of the journal entry. And we know it's 15,000, so I'm going to go ahead and fill that in, 00051. So we have a debit of $15,000 cash. Our credit in this case is going to be to common stock. Because it's a credit, and credit means right, we're going to kind of push that over here this way. So it's to the right of the debit. So there's, they can be an overlap, but you're going to start it here and then you're going to indent any of your credit entries. And we'll go ahead and fill that one in. So we have a debit of $15,000 to cash and a credit to common stock for $15,000. We have $15,000 on the left, $15,000 on the right. Our entry balances so that it completes that entry. We can then move it on to the ledgers. We'll do that in a different video. But let me show you an additional, a little bit more complex transaction along the same lines, starting a company. In this one, Phil the photographer is starting a photography business. He only has $15,000 cash to invest in his newly formed corporation. But he will be contributing camera equipment. He's only going to do $5,000 cash to invest in his newly formed corporation, but he will be contributing camera equipment with a current market value of $8,500 and a computer with a market value of $1,500 to his business. So in this case, he's not just contributing cash. He's also contributing some equipment, which will no longer belong to him. It will belong to his corporate entity because we're using, again, a newly formed corporation. Let's go ahead and set up our T accounts for this again. It'll make it a lot easier. So we've got assets on, I'm going to show them over here on the left. And we've got several different assets mentioned. We have cash, so I'm going to put that one first. And we know assets increase with debits and decrease with credits. Let's see if there's any other assets. There is another one of camera equipment. Any kind of equipment is an asset. So we're going to call that camera equipment. And again, it's an asset, so it increases with debits and decreases with credits. And let's see if there's any other assets here. And then there's going to be a computer. Well, computer is also a type of equipment, so I'm going to make that as another entry here. And that increases with debits and decreases with credits. We'll start with the cash. It'll be just like before for the catering business. We have $5,000 cash. We're doing this from the point of view of the photography business, so it has an increase in cash in its bank account of $5,000. So I go ahead and enter that. The next entry is going to be for camera equipment. And we look at the market value for that. If it has been newly purchased, you would use the purchase price. But in this case, it's equipment that he already owned. So he would have it assessed. And in this case, it's an $8,500 value. We're going to debit camera equipment for that value because it's an increase in an asset for the company. And the last piece of equipment that he is contributing as the owner is a computer with a market value of $1,500. So I'm going to put that here as an increase for computer equipment for $1,500. These items will remain on the balance sheet at their market value or purchase price until they're later disposed of. We'll discuss that in a different video. All of these items have been contributed to the corporation in exchange for the ownership, which would be the common stock. So we have the owner's equity. And it's a corporate form, so we're going to use common stock. And because it's owner's equity, it increases with credits and decreases with debits. In this case, we just add up all of the contributions, and they add up again to $15,000. So I'm just going to credit owner's equity for $15,000. Because we have $15,000 worth of debits and $15,000 worth of credits, this will now balance. Using this information that's on these T accounts, I'm going to do the general journal entries. And again, we're going to have debits on the left, credits on the right. So we'll start with the debits because that's where you should always start. So our first debit, I'm going to put cash. And we know that is $5,000. The next item to debit is camera equipment. And that is $8,500. And we have one additional debit, and that is for computer. Computer equipment, and that is an amount of $1,500. We now have entered all the debits. We can then look at our credits, which is again going to be indented, and you'll see it doesn't have to, it's okay if it overlaps, it's just going to be indented, and that's going to be for common stock. And we know from our T account it's going to be for $15,000. So I'm going to put that in here. If you were to add these up, you'll know that it's 15,000. So that's 15,000 worth of debits, and we have $15,000 worth of credits. Our account or our transaction now balances. So we can rest assured that it is correct. That is how you would account for the opening or the start of a company. If you'd like to see more videos like this, please subscribe to my channel. Give this video a thumbs up if you found it helpful. And I'll be doing some more of these. Go ahead and put in the comments the types of transactions you'd like to see or that you might be having difficulty with. Until next time, keep your grade alive and subscribe. This is Professor Capko. Thank you.